If the PHA has a federal program that is part of a cluster, but no other programs in the cluster, do you still note cluster? Absolutely. Failure to note that will come out on the peer review checklist. Uniform guidance. Bad debts are unallowable under uniform guidance. Has there been anything issued by HUD yet that they will be allowed?
There's an issue in there that says you can't charge bad debts to a federal grant. This has come up on the public housing side where I have tenants who didn't pay, so I have bad debt. You're not actually charging that to the federal grant. For gap reporting, it's in there. You're not collecting the rent, but you're actually not charging the federal grant. You're not drawing down subsidy for it. The other part of that is your subsidy calculation doesn't take that into consideration because you're doing gross rent in the calculation. So HUD has actually looked at this, and they have not come out officially, but that's kind of that's the thinking right now behind it. It's not being charged, and it's not in the subsidy calculation.
I think of it more that there's no cash disbursement being made to charge to the grant, so it doesn't apply.
Mike? Wasn't that the reason for the requirement to have board approval for TARs?
I look more at the board approval as an internal control issue, especially for smaller PHAs where you're providing the list to the board so they see it.
Historically, if I could add to that, historically the HUD required board approval. And since they dropped the requirement, basically you have to put it into policy or procedure. It becomes an internal control issue at that point. It's not,
especially in the smaller organizations.
Right.
Where you could be writing stuff off that's fraud to kingdom come.
Right. 200.45 CFR defines fixed amount awards as a type of grant agreement.
It's on the screen too, by the way, the actual 200.45.
Oh, okay. Let me read this. Entered which the federal awarding agency or pass-through entity provides a specific level of support without regard to actual cost incurred under the federal award. Could public housing in Section 8 be considered fixed amount awards? See also 200.201.
I have no idea. It's
I
Trivia Pursuit, and I'm not moving my pie piece anywhere.
I don't know if it's a fixed amount, but I mean,
I don't know if it's fixed because it's like say voucher, for instance. That's not fixed by any stretch. It's how many vouchers you're leasing. So we're.
Yeah, I mean, I've never actually even seen this before. So
I've never read through this.
I don't know what the person was doing last night, maybe this, but I've never seen that either.
Would accrued compensated absences related to FSS coordinator program be an eligible cost under 14.896? If so, would the liability be offset with cash or receivable to maintain zero net position? If receivable, should it be split between current and long term?
You can make the case that the accrued compensated absence is a benefit, and therefore you could charge that to the grant. I would not suggest doing that because sooner or later you're going to cap the grant amount, and then you're going to have this receivable sitting on the book, and what if you don't get the grant next year? Then you're just going to pass it down to the public housing program or HCV. I've seen this in the capital fund too, where people were using force account. Our recommendation is put this liability either in the public housing program or in the HCV, wherever your FSS coordinator is. But you can definitely make the argument that accrued compensated absences is a benefit.
Yeah, and I think here with the receivable balance, you would be booking an accounts receivable from HUD, and you couldn't draw down the funds, right, without the cash expenditure. So you'd be left with this accounts receivable with the grant, and then you use up your grant on true disbursements, expenditures, and then you're left with trying to either do a prior period adjustment or something to get that receivable off the books.
However, let me say this, that without exception, no matter what, spend 100% of the grant.
Absolutely.
And no more than 100% of the grant. And only claim 100% of the grant. which means somebody else. And yes, accrued compensated absence could be added to that up to the level of the grant. But the accruing stuff is just, it's just to keep accounting busy. So.
Okay, Chris, here we go.
The answer is yes. FSS escrow bank account should be part of the general depository agreement. It says all accounts.
By the way, has anyone had a problem with their bank signing that?
Sure.
I'm getting a lot of feedback now they won't sign them.
Yep.
Especially some of the bigger banks.
Grant agreements have that included in it as well.
Do they? Okay.
Yeah, which is shocking. Not really.
Yeah, but they, we are having agencies, and I was in Atlanta here 3 months ago, and it came up at the training class, and the field office director actually sent another letter out saying, we may work on the language at HUD, but you're gonna dang well get these. If you can't get that at one bank, you need to get it at another. That was it. That would be finding, yes.
I can't read that.
The problem that they're not making any money off the treasury bills. So you're forcing them to go out and purchase federal securities, which is being very, very low rates that they can collect, right, from interest. And they don't want to do it. You're forcing them to lose money, basically. Yes.
What's that?
So, you know,
they may be using their reserves at some point too, yes.
I mean, as an auditor, I have several clients that, you know, they're getting other securities pledged, state pledges. I mean, I'll kind of come back and say, all right, guys, you know, this isn't the rule, but I'm just happy they got pledges. And I'm not making it an issue.
Let me come back and say this. It's non-compliance, okay? Now, for me as an auditor, and I see this really from auditor eyes, I look at all the issues of non-compliance I get, and I decide whether I should report this as something to management. Should it be a finding? Is it a material? Is it so material it's a material finding? And now we're at report qualification. Am I at that report qualification? No. Am I at a finding? It depends. Is it non-compliance? Yes, always. But auditors, you're not tied to any one particular response to that. You have to evaluate the non-compliance and decide on the appropriate response to non-compliance based on the severity of that in the overall program scheme. Does that make sense? Okay.
We're debating question 4 here, GASB 68. You know, so no matter what the issue is, and, you know, Les and then we're talking a little bit, we're going to come up with this GASB 68 liability, and now we've got to allocate it and spread it between all the programs and AMPS and COCC, right? So then, pardon me? Yeah. I mean, we've got to get the cost over there. Someone's got to get hit with the cost. We can't leave a negative equity out there in a other program that's kind of out there. Somebody's got to pay for it. So the question,
well, it's theoretically possible. I could decide to leave it at the COCC.
Yeah, but what are you
do
going?
that.
You're still going to debit something, and you're either going to debit the due to, due froms, and then charge it off to the AMPS, and then they're going to end up with a due from, which is the same, or a due to, which is the same as the pension liability amount. But somehow we got to get the cost over on the books, and we'll talk a little bit here in a second. So the problem is going to be here. It is going to hit your UNP balance. That's the only thing you can debit. You got one equity account. We have to bring in a prior period adjustment to bring in the beginning liability balance. It's definitely not a restricted asset.
You're not charging it against HAP.
And we can't charge it against investment in capital assets. There's only one other equity account left.
Is that
Unrestricted.
a prior period adjustment or a special item?
They recommended prior period adjustment.
Yeah, it was PPA recommended.
But the problem is what happens if you don't have enough post to cover it. Yeah, and according right now with the FDS, what Chris was kind of talking about, it's going to force us to put in that number, taking it out of pre. I don't agree with it, but I think on the FDS reporting, it may force our hand on that a little bit.
Which is really unfortunate because there's not really any intention to go there, right? I mean, it's just that when you work down through the schedules, particularly on voucher, this is what we're dealing with. If I work down through voucher, I'm going to be stuck. It's not. We know it's not HAP, so it's admin, and you're going to be down to splitting it between pre and post. Unless you've really got enough post, which you're going to put it against post first anyway. But at the end of the day, you probably, if you're going to use a lot of that liability, or that if your liability is very high, it's going to pretty much chew your equity up no matter whether you're pre or post. Are there any exemptions or ways to get out of reporting the entire governmental entity on the FDS? Our housing authority is a discreetly presented component unit of the county that runs over 30 programs. Our agency has 323 units of public housing, 23 vouchers. Is there a threshold number of units? What authority does HUD have to require reporting of non-HUD programs? Can we combine all federal programs or federal grants and lump them into one column, non-HUD?
Well, I mean, my answer is that it really kind of here, because you are part of a larger primary government, the question is, do you have a separate audit? If the housing authority per se has a separate audit, then what? You're stuck. You got to report all 30 programs.
Well, maybe. Because there is one little exception.
No, I think they're saying the county has 30 programs. If you wrote the question, are you here? Or are you just counting on the tape being played later? Okay. Is it the county you're referring to as 30 programs? Oh, so the housing authority has 30 programs.
Are you audited separately? One single audit at the county level. At the housing authority level. And then you're consolidated up into the county's audit.
Okay, and are you a true housing authority? Are you a redevelopment authority, a nonprofit? So there's, and I don't have it, but there's an exception for this that says if you're in this case, HUD didn't care about the vast majority of these programs. So if like 50% of your public or 50% of your HUD programs was
they're not all HUD programs either, are they? Go ahead. They're not all HUD programs. How many HUD programs out of that 30? 3 or 4. The normal 3 or 4.
It said all you would have to give them is just kind of the HUD stuff, and we see that a lot on the Section 8 side, where I'm part of the city. We don't, HUD doesn't care about the fire department. So let me, if you give me your email or something like that, I can give you the citation.
PHA with 300 units, files 1 amp, no COCC, non-asset management with eliminations. REACT rejected submission saying we had to have at least 2 amps. Why?
I think a lot of times on these is for subsidy purposes, we split up separate properties or separate amps for subsidy calc because of the 250. Remember, the rule is 250. It's been bumped up to 400, but that just gets extended year by year. So we still typically have 2 subsidy calculations. So we do have 2 amps typically in PIC, although we're reporting it as 1.
Is this person here? They're here? Okay. Are you going RAD? You might want to consider doing a COCC. And I had this discussion with Ray. And it came up in an audit or a consulting that I do. And you might want to go ahead with the COCC because you get 6 months worth of funding up front that's taken away from public housing in such a way that it'll reduce the amount of money that's offset in subsidy in future years. So for that reason, smaller authorities, I have always recommended a COCC.
But I do
think sounds ludicrous.
Yeah.
But it saves money on the sequestration or the offset.
I do worry, look at your COCC budget and the cost that will be included in that COCC
Well, it's got
budget.
a cash flow.
Because it's got a cash flow. If it doesn't cash flow, then, and so my experience has basically been with the smaller ones, they can't cash flow.
And all mine have. So, okay. But basically, at the end of the day, it's an option. And that's the one thing I thought of. The
Yep.
REACT person was just having a bad day on this one.
Yeah.
And you could probably submit it the next time, and it would pass. It may pass. And here's the other thing, too. Having dealt with REACT and all that, some of the review procedures are not entirely consistent or consistently applied among reviewers. So if you end up with a problem, it may not be a bad idea to go back to the assessment manager and ask for clarification. Okay? I mean, if somebody's having a problem, bad day, whatever the choice is, right, or they're ill-informed, or they're interpreting, there is some leeway given to the reviewers, right?
No, there is. And, you know, my guess, they looked at something, they saw 2 amps, they saw in your FDS there was only 1, and that's as far as they pursued it.
That's it. Quality and substandard audits. Firms performing compliant quality are price cost costs similar to T2C firms. How do we solve this problem? I mean, we can't get everybody together on one page. I don't care how much we preach, teach, squeal, scream, pound our fists. There will always be somebody else who says and they legitimately think they can do this for $3,000. And I have no answer to that.
The real answer is with the agency and how they procure the contract, and whether they want a good audit.
That's where it comes down to. There's 2 really components to this. And the agency is really the first line of defense. Second, the problem we really have is peer review is not that effective at weeding out problem firms. Quite frankly, you can see a ton of failures where they pass peer review. Yeah. And I don't have an answer to that either. It's just something we have to deal with. And Ron, you were telling me the other day that you said, look, you found out if you really were, if the person, the PHA liked you, respected your opinion, you were giving good service, they were probably more willing to pay than someone who purchased it just as, I don't care who you are, just give me my paper.
Yeah, you know, you're trying to build up quality, and the issue's always going to be here, not just for housing authorities. We had this issue for nonprofits. We had this issue for governments here. You have a CPA that opens up shop out of his house. He has no indirect cost, no other staff members to pay, and if he can bill out at $70 an hour, he's as happy as he can be. And we're not going to be able to, compete with indirect cost and our cost trying to go against that type of individual. That's just the way some of these contracts will be. Okay? Now, I'm not saying anything good or bad about this person. They may be doing an excellent job. I was just looking. But, this is always kind of the issue that government auditing has.
It's never going to go away.
No.
QASS review. What kind of reviews are being done by QASS? Same kind. Are accounting firms being reviewed? Yes. Is QASS performing other types of reviews? Well, I think QASS is involved in a lot of other things. Chris may have addressed this now in terms of Wendell. There are really 2 parts to QASS, or Wendell's responsibilities, which it'll answer the last question at the same time. Go ahead, Chris.
So for a while, the IG took the function over again on reviewing auditors. They recently gave that back, so they're kind of ramping up on looking at auditors again, looking at fee accountants. The other part of it is they've been tasked with where they get complaints on a housing authority or a multifamily entity. Sometimes they'll go in and put a team in to do forensic auditing. So part of his team is doing some of that work. Every now and then, if the HUD comes over and takes over a PHA, they'll put in some of the staff to take over the accounting department for a while so they can get a contractor or something in. So their roles have expanded from kind of the accounting side and the review side. They've also been tasked with leading PIH's effort for enterprise risk management. That was just a fancy terminology to say there's not enough resources, we want to strategically look at housing authorities, or we want to look at different aspects of HUD's procurement and stuff and things. So they're leading kind of PIH's charge. The biggest thing you'll see is, you won't see because it'll be kind of invisible, is right now, HUD gets involved when PHAs are getting troubled. They're troubled, then, HUD comes in, working with the field office, they're trying to develop a system that says, we see you sliding down, and so they want to get the field office help the field office identify these PHAs, and then start talking to the EDs and the boards to say, okay, you understand that your cash position is going down. We see you're not filling your units anymore. Are you aware of this? So the idea is that the PHA doesn't hit rock bottom before HUD comes in.
Next question on LOCKS, FSS. Is there any chance that voucher funding is going to move to ELOCCS?
Probably not.
Can you talk about the debit and credit related to recording net pension liability and its effect on UMP?
No.
Well, you know its effect on UMP. What exactly? What UMP?
Yeah, I do think. Last I saw if you Google California GASB 68 pension statement, they got a white paper out. It's actually not too bad. It actually shows you some debit and credit entries with a little bit of an example.
The material I posted yesterday, I didn't go over, from state of Utah has entries too. But when let's put it this way. What are the entries when you adopt a new accounting principle? We're going to adopt this principle at the beginning of the year, right?
Yep.
So we're going to go back and what?
Prior period
adjustment.
Credit the pension liability for the balance.
That was
of
the
previous
easy
year.
part, right? And the debit goes?
Yeah, unrestricted. We can't get away from
There
it.
are no other place to go. That's a pretty easy, that's all it is. And it goes in as a prior period adjustment. I mean, a PPA, that was the goal.
I think the trick is going to be getting your data and understanding on what page does this number come from to put here and this page to go there, and really contact your state pension. They should have some
cases,
guidance
maybe the state
coming out.
auditor too.
Yeah.
When recording bond principal payment as hard costs under CFP is how is this principal payment shown as a reduction of loan liability? What is the entry since two income statements or an equity transfer?
I think they're talking about the capital fund financing program.
It
And the principal payment does get applied to the actual note on the balance sheet. The principal payment that's listed on the income statement, and correct me if I'm wrong, that's just a memorandum account.
That's a memo account.
listing out that. So you're not actually charging it to the income statement. You're actually taking it off of the balance sheet.
Now, he wants to know about two income statements.
Well, is the debt spread over 2 amps? It should be.
Could be.
Yeah.
If not, I think we're maybe asking ourselves about low rent or capital fund.
That's what I was thinking, maybe the low rent and the capital fund. And in that case, really the capital fund, trying to think of my accounting, that's going to be listed as a...
Interest cost there.
The interest expense will be listed on the capital fund program.
Yep.
And the principal payment being listed on that. So you'll be breaking it up between hard and soft, with the hard matching the principal liability, the interest being listed as an operating grant. The issue that you typically have, or that we have had, is when you try to start booking accruals on the interest payable. That typically kind of messes it up a little bit. And so we're trying to use the immaterial approach and not book that accrual if we possibly can.
For FDS purposes, what are the definite examples of when to use business activity or local, state and local?
Go ahead.
Go ahead, no, go, please.
The general idea of state and local, if it's a city grant or a county grant, something from the state, they want it because we know there's probably grant agreements, some restrictions on that. If it's in a business activity, HUD kind of looks at it's kind of like maybe you're running a management company or doing something like that on the side that's really free and clear, that the funds are in the business activity could really be used for anything under the PHA's control.
And maybe the confusion comes down to this idea of component units now, because in the old days, 10 years ago, we were recording lots of tax credits as business activities.
That was wrong.
There you go.
It was wrong.
It was wrong
back then.
And it was wrong then, and it was wrong now. And that's why we're talking about business activities, even multifamily. So let's say I was talking to somebody about a conversion to RAD. Keeping the program, if I went to RAD Section 8, or I went to PBRA, keep it under the tax ID number of the PHA. They don't have to have new debt. They're not doing tax credit. They're not doing anything else. If they wanted to go, if it made sense, they could go to RAD, and that would then be reported in multifamily, because now it's a multifamily program under the same tax ID number of the agency, so it stays in the column. Business activities would be maybe my management contract or something if I wasn't a separate company.
I tell you, business activity, what I would do with that is I would have my management focus in there apart from the operating fund rule in COCC. For example, everything that was truly non-federal or truly earned from other sources, you keep it as business activity. That way you separate the federal and non-federal pretty clear.
That's right.
And that's a good function. The other function with the local fund, of course, is with a grant or donation. You want to keep that separate from business activities because you want to track those local dollars.
And that's a good way to break them up now, because the usage has really changed over the last 5 to 10 years, and we've corrected a lot of those past issues.
And be really cautious. When you get donations, land given, deeded over from the city, don't put that on your public housing depreciation schedule or roll it into your voucher program. We really see a lot of this. Well, we're collecting this management fee, but I don't know where to deposit it, so I'm just going to put it into low rent and run it through as other income. We see that a lot. And basically, you just federalize these funds, which could be recaptured.
Took all your flexibility away.
Yep.
This one's yours. Annual funding for Eatonton.
Yeah, they're two different fiscal year ends. So basically, at the end of the day, you have the RAD funding, which is the current, the HUD funding that you would receive. So it's a timing difference between the two, because you had one at 95%, and then you have the current funding. So I was comparing the 95% funding with the current funding to see how they were going to cash flow. So it's a simple timing issue of when the funds were available.
I know what they mean by the positive decision, right? It wasn't really the difference in money. 671 to 695 wasn't the issue of the decision at all.
No, it was the freedom.
It was the freedom.
Yeah.
I'm out from under this. And that's, as I was talking to the other housing authority here just a minute ago, why would I want to get out of public housing? Why would I want to do this? Well, maybe it's just the numbers are the same, and I just want out of public housing.
Vonda made a great decision. It was the right decision to make, and it was going to cash flow. There was no debt, so I was happy with that. Even though I don't like RAD, it was a good decision for her.
We are looking at a 20% decrease in admin fees. Any suggestions? Now, this is complete tongue-in-cheek. I hope you get it. But convert to PBV through RAD. It's my point about why I don't like PBV conversions necessarily, because I'm always stuck with these prorations. But
now I would say this. You're doing yourself a disservice if you do not charge 100% of the cost of an HCV program into the HCV ledger. And the reason is this, is because Big Brother is looking at all the numbers and they're reporting it to Congress. So when you do that, guess what? They say, well, you don't really need the money.
Don't need the money.
And so you always report it at the full cost. Whatever it takes, you put it in there. And then if you need to make a donation from somebody else, then great, do that. But that's the only way Congress is going to get a clue as to whether you need the money or don't need the money.
We can tell you there are no suggestions to make up for a 26% proration.
Yeah.
There are none.
No.
But report the full cost, though.
I absolutely agree. We've got to get the cost of managing the program, the management fees, the bookkeeping fees. A lot of people are lowering the cost, which you can do. But for me, it's not the true cost of running the program, and I would rather have an operating transfer in from the COCC helping subsidize the voucher program to show the true cost. Back in that Section 7, of your book, we didn't get to it during my session. Everyone received an admin fee letter, right, saying this is going to be your new rate based upon the new admin fee study. And of course, you got to be real careful about that letter, right? Because they gave you the total dollar amount as if you would be 100% funded, right? And then they compared it to your 75% funded rate. So it's not apples and really oranges, really, when you're comparing those numbers. Now, I don't know where are you located? What state? Idaho? Okay. And so back in the Midwest, all of our clients got bump ups. Okay, so they're as happy. They're doing the happy dance a little bit here. And, so we're kind of coming in because they used some coefficients, right? They came up with a new admin fee rate, what was previously booked using FMRs of your two-bedroom site, right? So that's been taken away now. They're basing it on wages within your local state in some areas. So what you're saying is you're actually, from your rate, you're getting a decrease even further based on the new computation. Right. Now, I know that they're looking at some of these issues. I know there's going to be phase-ins. I know there's going to be a lot of comment periods. I don't know the end result as to what's going to happen.
And part, they've learned some lessons from the operating subsidy when they switched formulas and went to the regression model, and we had, you had winners and losers, for lack of a better term.
Gainers and decliners.
Yeah, gainers and decliners.
I got in trouble for using those words.
I know. So they've learned lessons from that, and so, HUD realizes it's a statistical model, and so, let's say your rate was $60 usually, and now it's dropping down to 58. They're thinking, well, we'll just keep it at 60. Because why do we want to really try to? It's a massive study, so why are we trying to really say it's that finite that we can say, yeah, you only need $58? So they're trying to do some of that to make any transition a lot easier. And I think it was around 90%. If we said, if HUD was funded you at 100% this year, then you could say that what the cost study said is as a portfolio you only need 90%. So kind of at a national level. So at an overall level, the study came out and said admin fees could decline a little bit, but again, what was in that funding letter really doesn't.
So you were saying your old admin fee rate was what? 70, and now it's going down to like 55? Okay. Yeah, I mean, there's going to be gainers and decliners here, and so from this point of view, I mean, understanding your concern, obviously funding is going to be an issue here. Long range, I would be thinking about possible plans to roll out. If indeed this happens, that you have a plan of action, I wouldn't necessarily share it with everyone, okay? But I'm always trying to say, okay, what happens? What if this happens? And we should all have some of these plans ready to roll out, right? What happens if our funding is cut 30% in public housing? What are we going to do? So, start thinking. You don't have to document it and do everything, but you might want to run some number games, thinking a little bit about if we have maybe potential people that's reaching retirement ages, if we want to fill those positions, or do we want to try to leave it open for a little bit? Working your way towards that. I don't think we've heard the end of it. Have you read the study? Okay, the study, they got a summary version that's about, 30 pages? And then you have the full version, which is, 250 pages? Or
read the Reader's Digest.
Yeah, read the Cliff Notes.
Okay, PBV RAT conversion. I'm going to let you take this one. Two public housing projects and the USDA converted all 100% of its units to RAD PBV on 12/1/2014. Fiscal year ends 12/31. The authority retained ownership of the property, gave up administration. Well, we went to PBV and didn't have a voucher program, so we're letting some other housing authority administer the vouchers.
Well, the answer to that one is you don't have, who's your cognizant agency? If you have no vouchers anymore and you have no money.
Yeah, where's the federal award going?
Yeah, it's USDA. It's not yeah.
The voucher money goes to the other agency.
Yeah, so that you're done with your reporting.
And now all we have is USDA money.
Which, if the loan balance is above $750,000, will still subject to single audit.
Yeah, but the cognizant agency, does it change? Yes.
Yeah.
Yeah.
It's USDA now.
Right.
Cognizant agency is USDA. I mean, you no longer have a REACT filing as far as I'm concerned. You got out of public housing. You gave it to a program, another agency who had the
You're
vouchers.
done.
You kept
And we
RD.
actually had that. We had an agency that I called up to REACT. Had a voucher program, 3 RD programs. They gave away their voucher program. They're left with 3 RD properties. And I sent a comment saying, thank you guys, this is the last FDS you're going to get from us.
That's it. We're done. And there is a large agency that made the choice to get rid of all their public housing in favor of vouchers. And they just they will retain the voucher program, though. All they kept was the admin fee. What they got rid of was the properties for a lot of reasons. But that changes. You're now an RD reporting property only. You file whatever they want. If you meet the 750 threshold, great. If not, you file whatever you file for the unaudited. You file in minks, and that's be done with it. Any REACT filings go forward? No. Tax credit property in an LP and presented as a discrete component unit. The housing authority is the 1% general partner and has $200,000 in equity. Does the $200,000 get reported in the housing authority's primary government column?
The answer always in a question this complex is it depends. But if that's the fair value of the capital investment, then yes. You want them reported in both. Yeah.
I mean, that's just that. I don't know what's to get around that.
Yeah, you've
Actually,
got to.
I have my investment. That's it.
It is what it is because you own 0.01% and somebody else owns 99.99%.
It's not the percentage that gets me.
Well, it is when it comes to the fact that when you explain this discretely
Well, yeah, as
unit,
far as the discretely
right.
presented component unit, but the 200,000 is the 200,000 sitting
it
there.
is the investment.
It is the investment, so it sits there.
Right,
Yeah,
exactly.
that entity, say I had it in the nonprofit that invested, that's now a blended component unit, and it's still on my books.
Right.
And I hope everybody got that yesterday. Let's say you get to that chart and you got the nonprofit that holds the asset down at the project level. I got the management company coming out here now as maybe a partnership, or I own it 100%, that's going to manage the project. I may end up with 3 different component unit discussions in that conversation. Every time I add a new tax ID number into that organization, I'm going to go through that conversation.
And we don't eliminate it in the upper financials, and we do not eliminate it in the FDS.
That's right. It does not eliminate.
Right.
Okay, I think that's it.